Hello friends, welcome back to the channel. What you see on your screen is a representation of a palm tree. Why I'm showing this palm tree in a stock analysis related video? Because this palm tree is representation of stock price. 90% of all retail investors, our focus is only on the stock price. When we want to invest in a stock, majority of us focus only on stock price or on stock price related metrics. Our actual focus should be on the business behind that stock price. And I must say, there are 10% investors who are actually focusing on the roots of the palm tree. And what is the roots of the palm tree? The roots of the palm tree is actually the business. The roots of the palm tree is a representation of the actual business behind the stock price. And because only few people are focusing on the real thing in stock analysis, that's why only these people are able to decode the multi-bagger framework. And when I say multi-bagger framework, this multi-bagger framework is nothing but how we are able to identify high growth stocks. And these high growth stocks leads us to what I call the real long-term wealth. So in this video, we will talk about this multi-bagger framework, how we can identify high growth stocks, and why we are focusing on high growth stock, because the real long-term wealth can only be built by investing in high growth stock. And when we are talking about high growth stock, if we will look only at the stock price, that is not the way to go. We have to focus here on the business behind the stock price. So let's start the video. What we have seen till now, that in order to build a multi-bagger framework for our portfolio, we cannot afford to focus only on the stock price. Our focus should be on the business side of the company. So let's take this discussion further. Now what you are seeing on the screen is a representation using which I will show you what is a multi-bagger. Here the most important question for us is, what type of business can be a multi-bagger asset for me? And what is a multi-bagger? Suppose you are an investor who has invested 1 lakh rupees in a company. Let's say after 3 years, your 1 lakh investment becomes 2 lakh. Then after 5 years, it becomes 3 lakhs. Then it becomes 4x, then it becomes 5x, and after 10 years it becomes 10x. This kind of investment profile has made your 1 lakh investment into 10x in 10 years. So this is what is a multi-bagger framework. And what kind of stock will give you this kind of return? This kind of return can only be achieved by that company whose business itself is growing at such an exponential speed. So if the question is, which stock can be a multi-bagger for me? The answer is that business which itself is growing at an exponential speed. So again, you see, the focus is on the business. If the business is not growing, the stock will not grow. And if the business is growing, the stock will follow. This is a very important thing to understand, that if we want our stock to grow very fast, we must ensure that we buy a business that itself is growing at an exponential speed. Otherwise, the stock will not grow. It will never happen that a business itself is growing at a very sluggish speed and its stock price will go 10x in 10 years. It will never happen. For the stock price to grow, its business must grow almost at the same speed. Only then we will have a multi-bagger in our hand. A weak, dead business cannot make a multi-bagger stock. Now that we have understood that what is a multi-bagger stock and how only an exponentially growing business can give rise to a multi-bagger stock, the next logical question that comes to mind is how to identify a multi-bagger stock. What you are seeing on your screen is a 3-legged stool, and which is a representative of a multi-bagger business. The balance of this stool is dependent on its 3 legs. The first leg is a representation of how profitable is the business. The second leg is the representation of how strong are the company's asset base, which we will find it in the balance sheet. The stronger is the balance sheet, the better is the business. And the third leg is a representation of how fast the company is growing versus what is the value at which it is available for its shareholders to buy. When we talk about profitability, we are not essentially talking about only a stagnant value of profitability. What we want to see in a multi-bagger stock is a sustainable and growing profitability. If the profitability is high, That is the first requirement. But that profitability level should be sustainable. It's not that in 1 year it makes a good profitability and in the next year its margin falls. When we say a 10 bagger, those are the business that has not only the capability to sustain its margins, but they can even incrementally increase its margin. The second very strong characteristic of any multi-bagger stock is how strong is the balance sheet, how productive are its assets, how dependent the company is on its debt. Is the company too risky? No matter if the company is generating profits, but to generate those profits is the company has to accumulate a huge amount of assets that makes the company inefficient. So that's why it becomes very important to also look at the balance sheet of the company to identify a multi-bagger stock. And the third criteria, which I think is one of the most important criteria in stock investing, especially for a growth stock investor, is the valuation versus growth balance. It's okay that we want to buy a growth stock, but if that growth is not available at a right valuation, we will not make a lot of money. So it is very important that we should look at the market price by comparing that what is the true value, the true worth of the business. If the true worth of the business is, let's say, 100 rupees and we are paying 1000 rupees to buy that stock, no matter how profitable is the business, no matter how strong is the balance sheet, this kind of valuation will never help us make money. Forget about having a multi-bagger in our portfolio. Whenever we will talk about valuations, we have to take into account the growth aspect of the business as well. Company which is growing very fast, its valuations will also be very high. Similar kind of business at a low growth may be available at 10 rupees, but same business model, but it is growing at, let's say, 10x speed, then its valuation will also be 10x. So whenever we talk about valuations, we have to always consider the growth aspect and then decide what is the true value of the company. So basically, whenever I try to screen my multi-bagger business, I use these three parameters to find my stock. The first, I start with profitability, then I look at its balance sheet, and then I look at its valuation. Now that we have understood that a multi-bagger business basically stand on three footings, and one of the footing that we have discussed is profitability. Now let's discuss how profitability of a business can be analyzed for the purpose of identifying a multi-bagger stock. So from the aspect of profitability of a business, the analysis can be done based on two main parameters. The first is the operating margin and second is the free cash flow. When we are talking about operating margin can be calculated by the ratio of operating profit divided by the operating revenue of the business. And how the operating margin should look like? Ideally, for a multi-bagger business, what we want to see is an expanding margin. Over the years, the margin should either be sustainable, or if it is showing a kind of expansion, that is best for the purpose of having a multi-bagger business in our portfolio. We will see this by means of an example. How does an expanding margin of a business looks like? But before that, let's discuss a bit about how we can calculate the operating profit of a company. We will look at the formula and then we will also look at the calculation. Operating profit can be calculated by using this formula. We will use EBIT. EBIT can be easily taken from the P&L account of any company, and in the P&L account we will also find two other items. First is the exceptional items and second is the other income. Both these metrics we have to subtract from the EBIT, and that will give us operating profit of the business. To calculate the operating revenue, we have to take the total revenue from the P&L account, and from the total revenue we have to remove the other income component. That will give us the operating revenue. So using these two metrics, we can calculate the operating margin of a company. The operating margin will be operating profit divided by operating revenue. I have taken the example of Bajaj Auto to give you a feel of how an expanding expanding margin looks like. For Bajaj Auto, I have done the computation of operating margin for the last 5 years of the business. And you can see the operating margin was 16.8%. In March 22, it fell to 15%. And then on, there has always been a gradual increase in the operating margin of Bajaj Auto. So this is one of the ingredients, the expansion of operating margin like this, the way we are seeing here. This is a trademark of a multi-bagger stock. I'm not saying that Bajaj Auto is a multi-bagger business, because we have to see other parameters also. But from the operating margin point of view, the operating margin not only has consistently increased, except for March 22 as an exception, but its operating margin has expanded from 16.8% to 19.7%. So this is one example of expanding operating margin. Let's look at the free cash flow. Free cash flow is a more stringent representation of the profitability of a business. A company which is truly profitable, if we are seeing only at its net profit, it will not be sufficient. To know actually if the company is making profit or not, we have to compute its free cash flow. And to calculate the free cash flow, we have to use this formula. We have to open the cash flow report of the company, and from the cash flow report we have to take the number which is net cash flow from operations, and then we have to subtract the capex from net cash flow from operations. That will give us the FCF. What is FCF? FCF basically is that cash which is available for the company so that it can use to expand or modernize its business. That's the way the business grows. The company should make enough profit. Out of that profit, it must have enough free cash available in its bank that it can use to make its business expand and also to modernize it. A company which is able to expand and also modernize its operations is a trademark of a multi-bagger business. So again, for Bajaj Auto, I have done the same kind of calculation. I have calculated the net cash flow from operations for the last 5 years, and also I have picked the capex numbers. So you can see in the last 5 years, the free cash flow of the company has gradually been increasing. It has started with 2875 crores in March 21, and till March 24, it went on to 5851 crores. But in the last financial year, the March 25, its free cash flow has gone down. And why it has gone down? The main culprit is here. The main culprit is the net cash flow from operations. The net cash flow from the company has become negative. Otherwise, in all of the last 4 years, the free cash flow of the company has only been increasing. This is a small representation of what it means when a company has a lot of free cash flow. You can imagine a large tank full of water, and that water is a representation of the free cash available with the business. And what the company can do with that free cash? That free cash it can use to transfer to its manufacturing facility for the purpose of expansion and modernization. The modern will be the manufacturing facility, the bigger will be the manufacturing facility, the more products and more high quality products it can produce. And what is the result? The result will be high revenues, more profits, and in turn it will take our stock from 1x to 3x to 4x to 10x in times to come. I have taken Bajaj Auto only as an example. I'm not trying to show that it is a multi-bagger business, but just to show you the numbers of a real company, I have taken Bajaj Auto as an example. It's not an investment advice. This is the disclaimer I want you to remember. Okay, now that we have understood that how to analyze a company on basis of its profitability, let's jump to the next step of how to check if the company has a strong balance sheet or not. As we have seen earlier, a multi-bagger stock shall not only have a strong profitability profile, but it should also have a balance sheet which is so strong that it can be called as a financial fortress. And this is what we are going to discuss in our next point. So basically we are doing 3 types of analysis of a company's balance sheet. We will first check the quality of its asset, then we will do its debt to equity ratio analysis, and then we will do the stress test on the company. So when we are talking about asset quality analysis, we will check how fast the company's assets are growing, and we will also check the asset efficiency. When we talk about asset efficiency, I'm talking about how much profit the company is able to generate per unit asset. If a company has a huge asset base but it is generating only very small profit, it is not good. But if a company can generate maximum profits with minimum asset utilization, with minimum asset base, that is an ideal situation. So for a stock to become a multi-bagger, its balance sheet must be asset light. And when I say asset light, it means that whatever asset base the company has, on that asset base, it is showing maximum efficiency, maximum amount of profit it is generating from its asset. The second characteristic of a company is its debt utilization. A company can do a fair business, but in order to do that business, if it has to undertake too much debt, it is not good. It makes the business too risky. So an optimum level of debt equity ratio must be maintained by the company. And as a rule of thumb, a debt to equity ratio below 0.3, I find it very optimum. Though it depends on the nature of the business, but the thumb rule is if the debt equity ratio is below 0.3, it makes me comfortable in investing in that business. And finally, what we do in the balance sheet analysis is the stress test. We want to understand how the company is behaving when there is a rate hikes scenario, when the GDP is falling of the economy, when there is a cost inflation going on. Under these conditions, how the company is able to manage its liquidity position, because these are all tough times for the company. And in this situation, how the company is managing its liquidity means how it is paying its vendors, how it's paying its interest dues to the bank. If the company is managing well even in these stress times, this is the quality of a multi-bagger stock. It is also essential to note that during such stress times, how the company's debt to equity ratio profile is changing. Suppose in good times, the debt to equity ratio, the company keeps it below 0.3. But during crisis situation, the company's debt to equity ratio becomes more than 3. It is not good. It means that this company is too sensitive to any changes in the economy. If the economy is doing well, the company will do well. But if the economy is not so good, this company is not so resilient, take a lot of debt, and hence it will become risky under tough situations. Generally speaking, these type of companies do not make a multi-bagger business. Let's proceed to the final method of identifying a multi-bagger stock, which is the value versus growth analysis. Before we start with the value versus growth analysis, I want to ask a simple question to you. Do you know what is a bad investment? A bad investment can be of two types. First of all, you are buying a bad business. That itself makes our investment bad. No matter in what price you buy, if a business is bad, it can never be a multi-bagger stock for you. The second type of bad investment can be you are buying a good business, but you are buying it at a wrong price, at an overvalued price. Even in this case, your investment will not become a multi-bagger. This is the reason why it is important for an investor to become very conscious of the valuation of the business. In the previous points, what we have discussed profitability, and we have also done the balance sheet analysis. All these analysis are done to assure that we are only investing in a good business. But in this point, we will discuss how to ensure that we are buying a good business, but at a right price. We are not buying it at a wrong price. So how to do this analysis? A simple framework. We will use two metrics here. First is we will use the PEG ratio, and second, we will use a concept called the margin of safety. What is PEG ratio? PEG ratio, it is the ratio between price to earning ratio and the EPS growth rate of a company. Suppose the P ratio of a company is 10 and its EPS growth rate is 5. In this case, its PEG ratio will come out to be 2. So how to interpret this PEG ratio number? Any stock on the scale of PEG ratio, any stock whose PEG ratio comes between 0 and 1, we can call that stock to be undervalued. This is the stock that we want to buy. If the PEG ratio comes in between 1 and 2, we can call that price as fair. It's not undervalued. We can keep that stock under watch list, and once its price falls and comes in this 0 and 1 range, then we can buy. And if the PEG ratio of a stock comes in between 2 and 3 or even higher, that is the stock which is overvalued. That is the stock that we want to avoid. Remember what we discussed? No matter how good is the business, we cannot afford to buy it at a wrong price. And what is that wrong price? This is that wrong price. When PEG ratio is 2 or higher, that makes a stock overvalued, and that is the wrong price. The second metric I want to talk about is the margin of safety. The margin of safety is basically a gap. It is a gap between the company's estimated intrinsic value and its share price. Suppose the intrinsic value of a company has been calculated, let's say it is rupees 100. And how we can calculate intrinsic value? We can do a DCF analysis, we can do fair PE analysis. There are a lot of financial models that can be used to estimate the intrinsic value of a stock. The most common one that we use is DCF analysis. Suppose you have applied DCF analysis and you found that a stock's intrinsic value is rupees 100, but its market price, let's say, is rupees 80. So you can see the market price is below its estimated intrinsic value, and the price is 20% below. So this is the gap. This 20% is your gap. The bigger is the gap, the better is the margin of safety. In order to find a multi-bagger stock, we have to remember that without application of PEG ratio, we cannot proceed. And if you want to be more sure that whether your stock is actually worth buying or not, whether it will become a potential multi-bagger in times to come or not, you have to do this margin of safety analysis as well. And to do margin of safety analysis, you must know the intrinsic value of a stock. Now this is the problem. Intrinsic value estimation is not such an easy thing to do. People who know to read and interpret the financial reports of a company, only they can do intrinsic value estimation. So if you have access to some websites, reliable websites who can do such kind of analysis for you, that is the way to proceed. For most investors, PEG ratio analysis should be good enough. But in this video, we are talking about multi-bagger stocks. We want to be 10x in 10 years. And if our purpose is to identify a great multi-bagger, we must pass through the intrinsic value step for sure. The bigger will be the margin of safety, more assured will be that your stock can convert into a multi-bagger stock in times to come. Now we have discussed all three metrics that can help us to identify a potential multi-bagger stock. To conclude what we have discussed till now, I want you to imagine an inverted funnel through which all 5,000 stocks that are listed in the stock exchange are made to pass through. And that funnel is not a simple funnel. It has 3 filtering sieves, and through that sieve all the stocks would have to filter itself and then pass. The first sieve will filter only those stocks which pass the profitability test. And what was the profitability test? Our profitability test was the operating margin and FCF analysis. Suppose out of 5,000 stocks that we are seeing, only 500 stocks pass through the profitability test. So now these 500 stocks that have passed the first filter, now it will be made to pass the second filter, which is the financial fortress filter. And what was that filter? In that filter, we will do the asset analysis, the debt equity analysis, and the stress test for the company to check that whether it has sufficient liquidity or solvency or not under tough times. And suppose after doing this analysis, only 100 number stocks pass through. So we started with 500, and after the second filter itself, what we are left was only with 100 number stocks. And the final filter that we will apply is the valuation and growth filter, where we will test our stocks for the PG ratio and for the margin of safety ratio. And suppose after doing all this analysis, the stock only 10 number stocks pass through this final third filter. At the end, after doing all this, after filtering all these 5,000 stocks, we have left with only 10 stocks which can become a potential multi-bagger in times to come. In this video, I started by showing you a palm tree, and palm tree was a representation of a stock price. And if our objective is to find a multi-bagger stock, our focus should not be the tree, our focus should be the roots of the tree, which is symbolic of the underlying business behind a stock. And when we will focus on the underlying business, what we are trying to do is basically we are trying to create our funnel, and through that funnel we are filtering all the stocks that we have listed in the stock exchange with the target to have these potential multi-baggers at the end. I hope you liked the video. If you like it, please do consider subscribing to my YouTube channel. Thank you very much for watching.